Would you rather buy the bubble or miss the boom?
I don't think you have to buy the bubble. I wouldn't want to miss the boom. Option 3.
If history says high valuations mean poor future returns, why do investors keep ignoring that?
I think because they're not looking. Every single sample where investors have bought the market on over 23 times earnings, their subsequent 10-year real return has been below 0.
If you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
You can participate in this AI industrial revolution without being reckless as an investor.
Neil, let's pick up where we left off last week. We were talking last week about the relative strength of the strategies, particularly Unstoppable Trends and your top 40 strategy. And when I asked you about those last week, you said you weren't planning to reposition them just yet. Despite the strength that we've seen, your top 40 is up since you created it, which is about 6 months ago. It's up 54%, over 54% as of yesterday. So clearly that approach has paid off, not positioning or not repositioning. Can you tell us what's been driving that performance so far and what you're seeing behind or beyond the headlines that gives you the confidence to stay put, to keep the strategy as it is?
Well, there are a couple of things I should mention. First of all, the strategy has performed much better than I would have anticipated over such a short period of time. I'm quite surprised by that. Secondly, across the board, across the strategy, all the sectors have contributed to performance. Now, that doesn't mean everything's performed the same by any means. And there have been one or two outstanding contributors. But broadly, I'm very pleased that the performance has come from across the sectoral distribution of the strategy. The standouts really would be the renewable energy companies in the strategy, the Chinese stocks in the strategy, the semiconductor stocks in the strategy, and one or two UK companies in the strategy. So it's been across quite a sort of broad spread, which are the candidates that I specifically chose.
Now, the reason I wanted to ask that question is because I can imagine people, if they've been onto the W4.0 website and they've looked at the performance of the strategy, they could assume that it's, fully exposed to maybe the Magnificent Seven or the S&P 500 or, those stocks that we're used to seeing that kind of performance from. But that isn't the case with this. These sectors that you're exposed to or that you've created the strategy around are very specifically not the S&P 500 or the Mag 7.
Very specifically not, John. Yeah, you're right. As I highlighted when the strategy was put together, I felt then and still feel today that the Mag 7 and that sort of popular collection of technology stocks in and around the Mag 7 are overvalued. I find it really hard to rationalize the excitement that surrounds those businesses.
We'll definitely come back to the Mag 7 valuation piece slightly later in this episode because there's a chart that I want to show you and ask you about again, which I know you've spoken about before. But before we get to that, I wanted to just try and understand, how do you decide, okay, now's the time to reposition? What is it that you're looking for, or what is it that you spot that helps you or helps anyone, I guess, when they're following any investment strategy? Because it's almost as hard to know when to change course as it is anything else.
Yes, it is hard. And it's hard because it's judgment. There's no scientific formula that you can apply that spits out an answer. You've got to exercise judgment, but that judgment is informed. It's not based on ignorance. It's based on information and analysis. And the key guide to changing strategy is not a product of thinking, oh well, now that I need to refresh the strategy and highlight something else that I believe in the long term. It's all driven by valuation considerations, and those at the heart, as I've always said, those at the heart of all the decisions that I take. As I said, this is all about judgment. It's art more than it is science, but it is based on information and analysis. And so the strategy will evolve as and when I think that the valuation of the constituents of the strategy more than, if you like, overestimate the potential future returns, the potential future earnings of those companies. So that's the thing that will drive me to want to exit some of the companies in that strategy and to look for other candidates where there is fundamental undervaluation and to be exploited.
Neil, I saw another headline this week from The Economist. I know we had an Economist headline last week and we seem to have another one this week, but again, this one just caught my eye. The headline was, "Could a market crash torch $35 trillion in wealth?" As obviously a fairly spectacular number. The article was actually talking about how the world in general is pretty reliant on a handful of US stocks, namely the Magnificent Seven. For those who don't know, the Magnificent Seven is Apple, Microsoft, Amazon, Alphabet, which is Google, Nvidia, Meta, which is Facebook, and Tesla. Now, I want to draw your attention to a chart that we talked about during one of the live events at the start of this year. I think it was in January. The chart in question is actually, it's a JP Morgan chart. They published it at the beginning of the year, and it shows the 10-year real return of the S&P 500 based on the starting price to earnings ratio. So Neil, what I think this chart illustrates quite starkly is that when you start from a high valuation, your long-term real return tends to be much lower, and vice versa. Now, the starting PE ratio of the S&P 500 is about 24. Why do you think markets are ignoring this relationship at the moment?
I had a very similar chart to this in a blog I wrote last year, which mapped this sort of relationship between valuation and subsequent 10-year real return, and it included the UK market and the US. And I used it actually to argue the point I'm going to make again today, which is you should not expect the 10-year return from the S&P 500 to be particularly good, because the valuation now is very high. Now, I think the reason that people ignore this is partly because they might well be ignorant of it. It might also be the product of much shorter investment time horizons. I am unusual. You know, people like Warren Buffett, who've advocated long-term investment approaches, they do tend to be in the minority. Most investors, most institutional, certainly most retail investors, tend to focus on much shorter time periods. They think about next week, next month, perhaps the next 6 months. You know, a year might be considered very long term. In my view, 10 years is long term. You know, and it is longer time periods over which you should think about your investment strategy. So I think maybe that there's a sort of, there might be a tacit acceptance that, okay, so the multiple means that a 10-year real return might be very poor, but over the next 2 or 3 years, I can see the next 2 or 3 months, I can see the market continuing to go up. So I think there is this temptation to sort of want to ride the wave whilst the wave is still in place, and not really worry so much about the longer term, because of course most people think, well, you know, I can just jump off and go and do something else when it's obvious that the market is about to go down, which of course it never is.
But can you just explain the chart for us and what we're seeing?
It shows a relationship in financial markets that everybody will be familiar with from their everyday sort of behavior. Whether you're buying a house or a car or any substantial, significant item, value considerations dictate your desire or your purchasing decision, whether it's a Mars bar or whether it's a 4-bed house or whether it's the car that's going to carry you around for the next 2 to 3 years. There are value considerations based that sit behind all of those activities, all of those purchasing decisions. And the same value considerations should sit behind an investment decision. And the fact is that if you overpay, you overpay. And you pay for that. You pay for that in a residual value, in not being able to sell the asset that you bought for a price higher than you paid for it. All of those sorts of things. So what this chart highlights is that in financial markets, and particularly in the equity market, if you overpay for an asset today, you are likely to pay for that mistake over the next 10 years. It doesn't mean that tomorrow the share price will go down or that a bubble will burst. It doesn't mean anything like that. What it means is that your 10-year future real return is likely to be poor. And in fact, what the chart shows unequivocally is that based on history, your return is guaranteed to be poor over that 10-year period. There isn't an outlier. Every single sample where investors have bought the market on over, I think it's 23 times earnings, their subsequent 10-year real return has been below zero. I think history is an important a guide to how we should expect returns to map out over the future.
So if investors today are looking at the S&P performance and expecting the next 10 years to mirror the last 10 years, which have been outstanding, they're probably setting themselves up to be disappointed.
Well, they are, or they must understand that they're expecting something to happen that has never happened before.
Okay. That's an interesting way of putting it. You're betting against all the way back to 1960, I think that chart.
Yeah, you're betting against history.
Something that hasn't happened in the last 65 years. How does that perspective feed into how you position? Does it just play into your natural valuation focus?
It just plays to my natural valuation focus. The sort of considerations that are represented in that JP Morgan chart are the considerations that have guided me as an investor over the last 35 or more years, 35, 40 years. So it seems quite a long time actually. But anyway, those considerations are the ones I'll have always deployed when I've been thinking about what to invest in and what not to.
Yeah, so I guess you've seen at least 50% of the dots on that scatter plot that we saw.
Yeah, I have.
Good. Well, let's move on to China and the US. Trade tension seems to be back in focus, and there was a lot of confusion, I think, over China's export ban or restrictions on the export of rare earth metals, which are obviously really important for the semiconductor industry and for all kinds of consumer goods and electronic products. I didn't really know what to make of what happened on Friday and the subsequent sell-off. Everything seems to be back to where it was before or higher than it was before. Is this just another flare-up in the ongoing economic war or tension between China and the US, or is there more that we can read into it, do you think?
I thought when I first read it last Friday, by the way, it was after we'd recorded this session last Thursday, when I said I didn't think there was an imminent bubble burst about to happen in stock markets, and the following day the market, the S&P has a terrible day, and you can just imagine people thinking, look. The point is, the market just corrected on the back of increasing trade tension, or the appearance of increasing trade tension. My interpretation of this is that this is posturing ahead of the summit that's going to take place later this month in South Korea, where President Xi and President Trump will meet and talk about all of these issues. My hope and expectation, I'm sure it is with everybody, is that those discussions, face-to-face discussions, will result in some more permanent resolution of the current round of increasing trade tension, which has been on hold, remember, for some time. I mean, there's been, the news has been on the whole relatively good in the last 2 or 3 months, as the increasing tension which had preceded it was calmed down with 90 days sort of rolling 90-day stays of execution, if you like. And I saw President Xi's sort of statement about rare earths as a sort of bargaining chip that he was advertising ahead of that meeting with Trump. I think, again, I would not have reacted. I didn't react. I wouldn't have wanted to react to that story on Friday. I don't see it as that significant. And let's see where we get to later this month in South Korea. I'm hopeful that the two sides will agree some sort of grand trade bargain. They both come to that meeting with a vested interest in securing some sort of long-term trade agreement. It's clearly in the economic interest of both the US and China. So I expect a decent outcome. Let's see where we get to.
Neil, let's talk UK productivity data. We talked about it a little bit last week. I know you've been critical of the ONS a lot. You've also been critical of the UK's productivity figures before, and this week's update from the ONS seems to have given yet another reason to be distrusting of the output. So just to summarize, they're saying output per hour worked is up 2.1% compared with pre-pandemic levels, but you've argued that those numbers are fundamentally flawed. What is wrong with how the ONS calculates productivity?
I don't have enough access to the data to know exactly what's wrong. But what I do know is that it's wrong. It just does not make sense. And I've written on numerous occasions in recent months about why I think there are flaws in the data. And I think I pointed to some pretty tangible evidence, some pretty credible evidence that demonstrates the flaws. Productivity in particular is an issue. First of all, because the ONS has really struggled to measure accurately output. And of course, when you're measuring productivity, it is basically hours worked and output. It's a measure of the relationship between those two things. My concern has been largely focused on the ONS's inability to accurately measure output. That's been something I've highlighted, particularly in respect, interestingly, in the manufacturing industry. But this week, on the back of the labour force, the labour market data, I looked again at the other bit of that productivity equation, which is how many people are there in work. And it's very clear to me that the ONS is having real problems giving the government and all the other statistics bodies and all the other sort of important decision makers an accurate measure of how many people there are in work. And indeed, I'm not alone in thinking the ONS has got this problem. The ONS have they have admitted in the release earlier this week, the ONS themselves admit quite on a number of occasions that the LFS data, the labour force survey data, it's a survey, by the way, a survey of households.
Yep.
74,000 households that are interviewed to provide data on which the ONS estimate what's going on in the labour market. Seems an odd way to go about doing it, but nevertheless, that's what happens. There are 34 million people employed in the UK. So roughly 1 in 500 people who are employed apparently are interviewed to find out what's actually going on in the labour market. Not sure that's the best. I wouldn't certainly go about it that way if I wanted to find out. What we've got is the ONS admitting that its labour force survey data is not accurate. And in fact, I think there was a shocking admission at the end of a section in the ONS report this week that was dedicated to the LFS, the labour force survey itself, which said, I'm going to quote, LF estimates are currently not considered accredited official statistics and are designated official statistics in development. The labour force survey, on which everybody estimates what UK economy productivity is historically, and of course that base number it forms a really important part of, for example, what the OBR estimate is going to happen to productivity going forward. What the ONS say is that those data are not accredited official statistics. Now, I've seen no reference to this whatsoever in any of the apocalyptic summaries about what's going on in the UK economy and where the economy is going this week, for example. So the Economist article, great example. I think the IFS today have talked about a 22 billion hole in the fiscal arithmetic as a result of their interpretation of what they expect the OBR to say about productivity growth over the next 5 years. So here we are, once again, confronting a situation where all sorts of very learned, very smart, apparently very intelligent people are making judgments about how much tax needs to go up in the UK on the 26th of November. But they're basing those judgments on data, on forecasts going out 5 years, but on data which the creator or the owner of that data says they're not accredited official statistics. And they're not official accredited statistics because the ONS themselves know that they're not right. They know they're wrong. They know there are flaws in the data. You've just got to pause for a moment and think, what? How can the Chancellor of the Exchequer base tax decisions in a few weeks' time on utterly flawed data and forecasts of going forward from flawed data, which the OBRs state themselves are effectively uneducated, educated guesses? You couldn't make it up. It's nonsense. It's madness. We just shouldn't be doing that.
So let's say those figures in the LFS are wrong. What is the downstream impact of that? Because, you might be listening to this saying, well, so what? Maybe we're slightly off on unemployment or slightly off on productivity. So what? What does it mean?
First of all, I think the data is understating UK productivity. Productivity in the UK is much better than the ONS estimates, partly because the ONS have themselves underestimated output. There was a correction a few weeks ago to GDP, nominal GDP. In fact, at the end of June, nominal GDP was upgraded by 2.25% from the forecast the OBR had in place in March this year. That's about £60 billion of output. So not only is there an upgrade to the size of the economy, I think the ONS are overestimating how many people are employed in the economy. Seems a very basic thing, but when you know that they calculate that from interviewing 74,000 households and there are 34 million people in work in the UK, you can start to understand why there might be some mistakes there. Now, what I've done is look back at these data series, because there are other measures of how many people are in work. HMRC, for example, as you would expect, have data about how many people are in employment, because of course they need to know. They're collecting taxes from them. And what it shows is basically that the data series were consistent with each other up to the pandemic. Something very seriously went wrong with the data in and around the pandemic. And there's been significantly greater inconsistency in the data since the pandemic. Now, specifically, over the last 2 years, let's put it over the last 12 months, the HMRC estimates that in 9 of those 12 months, the number of people in payroll employment has gone down in 9 of those 12 months. I think the ONS estimate in the LFS survey says employment has gone up in every month of those 12. You can start to see why the data's wrong. You can start to see there are inconsistencies there. You can start to see that the ONS themselves say, don't rely on this data. Well,
yeah,
I wouldn't. And I don't think the Chancellor should. And neither, by the way, do I think the OBR should either.
What is the likely impact on people listening to this if these numbers are wrong? So we've got a budget coming up next month. The very likely scenario is that taxes are going to be increased. Are they going to be increased more than they need to be? Is that really what you're saying?
Yeah. If the Chancellor succumbs to the noise, the nonsense, the sort of the doom-laden consensus says there's a massive black hole. Look, UK productivity over the next 5 years is going to disappoint. We're going to have lower growth as a result. Lower growth means lower tax revenues in 29-30 than the Chancellor forecast back in, or the OBR forecast and the Chancellor embraced back in March this year, and indeed back in October last year. Lower tax revenue means there's a gap in the fiscal arithmetic. That gap has to be filled today. Oh, by the way, that gap exists in 29-30. That gap has to be filled today by tax increases now. What will happen as a result of tax increases now? It will vaporize business and consumer confidence in the economy. Higher taxes means lower growth now. What is the thing that the economy needs more than anything to solve the potential fiscal challenges in the future? It needs more growth. The Chancellor must do all she can to enable, to free up the economy so that it can grow. The Chancellor knows that we need lower rates to sort of trigger that better growth outcome. I think lower rates are coming because inflation is coming down, and the Bank of England will cut rates. I think they may well cut rates in 3 weeks' time in the November 6th meeting. That's really important. But fundamentally, if she succumbs to the nonsense, this idea that let's base our 5-year sort of educated guesses on data that we know the ONS themselves know is flawed right now, that is the manifestation of economic madness. It's lunatic. Let's kill the economy now because, nobody would do that. Nobody would do that. It's mad. And yet, that is what the economic consensus says the Chancellor should do. The Economist says it. The IFS says it. The Daily Telegraph says it. We're all doomed. We're all going bust because of these ludicrously unreliable forecasts. If I was a Chancellor, I'd say, sorry, I'm ignoring that nonsense. It's nonsense. You cannot, in all credibility, tell me that those numbers are reliable. They're not reliable. I will base my tax decisions, my tax and spending decisions on contemporaneously more reliable economic data.
I guess the difficulty is doing something like that requires quite a lot of, I guess, bravery, because, if you call that wrong and it turns out their data was right, that's going to be catastrophic in the future if she doesn't raise taxes enough.
Not necessarily, John, because what she can do is adjust tax bill. What she can announce today is a commitment to fiscal responsibility. On the November 26th, she can say, I remain committed to fiscal responsibility. I will adjust tax policy in the future to reflect the numbers that emerge over time. If the economy disappoints on growth, if the economy disappoints on productivity, we'll have to raise taxes in the future. On the other hand, if I'm right, I'm not pretending to be a Chancellor, by the way, but if I'm right about where the economy is going to go, how we will outperform the doom-laden consensus forecasts, if we grow anything like as fast as I think, there will be no fiscal hole in 5 years' time. None at all. Indeed, there will be the fiscal numbers will look much better than expected. She could even cut taxes in the final year of her administration. Quite easily. It all depends on what happens as you evolve. So she has the opportunity. She can say, we remain fiscally responsible. I will adjust policy. I will adjust tax policy to reflect the new information that will emerge over time. At the moment, we are, I think, the second fastest growing G7 economy. The economy has grown. According to the ONS, in every quarter since this government was elected. Nothing to do with the government, by the way. But just imagine how fast the economy would have grown if it hadn't been hit in the face with a baseball bat when we had much higher increases in taxation last October. Imagine how fast the economy would have grown then. The fact is that there is growth potential in the economy. It is being unleashed. It will be triggered by lower interest rates. We scored an own goal on inflation as a result of all the measures that were introduced in the budget last October. That's created more inflation than would have occurred had we not had those measures. But inflation is going to be coming down significantly. It starts in October. November data will show October's inflation numbers. Okay. And so I think interest rates are definitely coming down. They'll come down more quickly than people think. This will unleash growth in the economy. If I'm right, the budget arithmetic will look after itself. The economy will generate through that growth the revenue that she needs to bring the deficit down and to give her the headroom that she needs the 10 billion headroom that she needs in fiscal 29-30.
Let's talk about tech, which is undeniably my favorite topic. ASML, TSMC, both reported really strong results this week. I'm sure that will continue fueling more talk of an AI-driven bubble. Where do you think the line is between people being overly optimistic about the potential future of these companies and the real potential driven by all of the huge amount of spending that we're seeing from these leading AI companies?
That's a really interesting question, and I think it's very hard to answer it in precise detail. It's hard to be clear about where the hyperscalers are going to get the returns from deploying AI across the economy. It's hard to see how their returns can justify the scale of the current levels of investment. For example, OpenAI is budgeting to spend something like $1 trillion. That's what some estimates I've seen of what their projected spend is likely to be over the next few years. I have no way of making any judgment whether there will be an adequate return on that $1 trillion of investment spend. But it's hard to make that judgment about what the appropriate, what returns will on that huge level of investment that OpenAI or Microsoft or Meta or whatever, all these other very large companies will make. I think it's easier to make a judgment about NVIDIA because it isn't like those other companies. It is one of the Mag 7, but it's manufacturing the chips, which form a very important part of this sort of global investment boom. But having said that, it is, I think, much easier to make judgments about what future returns will be from companies like TSMC, ASML, SK Hynix, Micron. These are the picks and shovel suppliers to this AI industrial revolution. And I think it's much easier to make judgments about those businesses and the returns that they will see going forward than it is about the hyperscalers themselves.
I'd like to understand what your read of both of these sets of results are. They're both hugely important companies.
So let's deal with TSMC first. Their numbers were out, or their Q3 numbers are out today, and they're better than expected. And for the second time this year, the CEO has upgraded his growth expectations. So revenues are up 39% year on year in Q3 for TSMC, which is way ahead of what he thought they would be in Q2. And this has created a lot of excitement. And it's very clear that despite the fact that TSMC's opportunities in China are becoming more constrained because of the politics and because the Chinese administration is keen for domestic Chinese chip manufacturers to take the place of their reliance on international providers, like TSMC, which is obviously Taiwanese. The fact is that what the CEO says is that the AI-driven growth that they're seeing is more than compensating for that less optimistic outlook in China. So this is all really about the capital investment that I've been talking about for some time now. That huge level of investment in AI infrastructure is obviously feeding through into the likes of TSMC very, very clearly. ASML, which is this unique business that manufactures the most incredible machines.
They're the only company in the world, by the way, I don't know if people know this, the only company in the world that make the extreme ultraviolet lithography machines that are used to basically print semiconductors. I mean, that is, it's astounding that there's one company in the world that every fabricator of semiconductors relies on their equipment. Yeah,
so TSMC buys machines from ASML, this Dutch business. It's a big European company, but it's a crucial cog in the global semiconductor industry. I've tried to understand exactly how their machines work. You sort of require a degree in physics to really understand it.
I've watched a few videos on it, and let's just say it involves shooting lasers at molten blobs of tin flying through the air and turning it into extreme ultraviolet light.
Yeah, and they're layered in atom level sort of thickness. I mean, it's mind-boggling, frankly, what their machines are capable of doing. Anyway, ASML was forecast. The sort of growth I've just talked about in respect of TSMC wasn't what you saw at ASML. ASML obviously get revenue from selling these very expensive, very, very sophisticated machines. It's quite a lumpy business. The view was that their third quarter would be down and that 2026 they would see less revenue growth or lower revenues, in fact, than they would likely to see in 2025. In fact, what ASML reported was that, in fact, 26 would be up on 25. And so at the margin, the results surprised to the upside. It wasn't that they were delivering 40% per annum growth. That isn't the case. It is a growing business. And clearly the future expectation is that the business will continue to grow rapidly. But right at the moment, basically, there's a lull in ASML's order delivery schedules. And as a result, the growth is sort of plateauing. But at the margin, it's better than the analysts had expected ahead of these numbers. And as a result of that, the share price rose on the day of the numbers. And it's been a good performer in recent months too.
What has to happen for you to call time on that approach, the picks and shovels approach that we've talked about before? What would you need to see in order to say, right, that's it, I'm shifting away from that now? Or is it too hard to say?
It is hard, but I can tell you where the alarm signals will be fired. They'll be fired in valuation terms. So when I start to look at these companies and see that their valuations don't reflect or become too stretched in relation to what I think is achievable, those will be important triggers in my mind that would alert me to the need to change strategy.
Final topic for this week. We've seen both Jerome Powell and Andrew Bailey both sounding more dovish this week. Powell hinting the Fed could slow or stop quantitative tightening as early as 2026, and Bailey saying the UK's cooling labour market supports a gradual path to further rate cuts. You had central bank rate cuts as one of your big themes of the year, so anything on this topic is always going to be interesting, I guess. What's your take on it?
Yeah, I think this is notable. It made me, when I read what Powell had said, I sort of reread it and took note of what he'd said. I think there is a shift in his opinion. I think there's a more widespread shift, actually, a more noticeable widespread shift in Fed thinking about two important things. First of all, they've become much, much more relaxed about the inflationary implications of Trump's tariffs, something I said they would do back in April this year. Secondly, I think they've become more cognizant and more worried about the weakness in the US labor market. Now, right now, because of the US government shutdown, the data is delayed. They're not getting visibility on all of the sort of data that they would normally get. But there are other anecdotal surveys, evidence from private sector companies who analyze the US labor market. So they're not without information. And I think in general terms, I think Powell is increasingly worried about the weak labor market. So a combination of less concern about inflation and more concern about the labor market must mean that rates are coming down in the US more promptly. So I think there may well be two more cuts this year, which is sort of what I believed actually at the start of the year. There was a period in the wake of Trump's Liberation Day announcements when consensus believed that, in fact, interest rates might have to go up instead of coming down. That sort of slightly silly view has sort of melted away, and there now is a sort of building consensus that Powell, the Fed, will cut rates. Of course, this is, and I see this not as the product of them succumbing to Trump's pressure on the Fed to cut rates. I just don't see it. I think Powell has been very clear that we're just sort of, fingers in ears. We're not listening to that pressure. We're going to make judgments based on what we see from the economy, and the data is showing him, that it's time to cut. So I think rates are coming down in the US. As far as the UK is concerned, we still have members of the MPC who, frankly, I think are just looking in the wrong direction. They're looking at sort of sticky inflation and all these sorts of terms, which I think is wrong. Inflation has picked up in the first 6 months of this year, but it's picked up entirely because of the administered inflationary problems that for example, the government has inflicted on the economy. And as a result of those inflationary events, inflation has ticked up, and it may well be close to 4% at the next reading. But that's the peak, and the MPC does know that pretty much from October, inflation is going to start to fall significantly in the UK. Now, Bailey's comments were interesting. It's the first time I've really heard him sort of go out on a bit of a limb and say, look, I'm a bit worried about the weak labour market data in the UK. So my sort of guess is that the chances of a cut at the November 6th meeting have gone up. I don't think it's absolutely certain, by no means, but I think it's more likely that we'll have a cut now on November the 6th. If the MPC doesn't cut, then I think it's almost certain they'll cut in December.
And does that change anything materially for investors, do you think?
I think it underwrites my economic thesis for what's going on in the UK and what will happen next year. Remember, based on what I think is going to happen between now and the end of the year, I think the economy will grow on average through 2025 at something like 1.5%. We will exit the year at something like between 1.6 and 1.8%. So effectively an accelerating trend. Consensus believes that growth will slow in 2026. Now remember, we've grown at something like 1.5% on average in 2025 with the headwinds of much higher inflation than we would normally have had. A very, very slow pace of interest rate cuts, increases in tax, lots of uncertainty, lots of sort of negative rhetoric and press commentary about the outlook for the economy. Next year, lower inflation, lower interest rates, by no means the same level of tax increases. In fact, arguably no tax increases next year. And I think how that translates into growth that's slower in 2026 than we've seen in 2025 is I just don't understand how consensus believes that. So my view is growth accelerates in 2026. There's not a massive leap of faith. Economy's going to accelerate in 2026. I think we'll grow above 2% next year. And that's a product of principally because lower rates will liberate more spending, less saving. Simple.
Bring on the lower rates. Well, that is all for this week. Thank you, Neil, as always, for your time. If you are listening to this and you would like to explore Neil's top 40 along with the other W4.0 strategies, you'll find the link below in the description of this video. And we've created a special offer for podcast listeners. You can use the offer code PODCAST to get 30% off your first month or your first year's subscription. We will be back with more next week, but until then, take care.
Bye for now.